Hello everyone and welcome to BNSN on campus with me, Avan Dabash. This time around we've trekked all the way to Noida and we're at the Amity University at the sprawling campus. I'm surrounded by sharp young business professionals and we'll be teaching them and empowering them how to gain in the stock markets. So joining in on the show today we have our two market experts. Sanjiv Bhasin, he's the Executive VP Markets and Corporate Affairs at IIFL. We also have with us Ashu Madan, who is the President of Equity Broking at Religare Securities. Welcome to the show, gentlemen. Lovely to have you with us. And what a great time. The markets have been throughout a tumultuous ride so far. We've had global events, domestic events, and so far things haven't been all that rosy, which is perhaps why our young students over here are a little apprehensive to put their money into the stock market. So let's hope that we turn things around today. Sanjeev, in fact, I was going through your presentation and you happened to mention that don't try to be an investor and a trader because it'll end up a disaster. Can you just elaborate on that?
Yeah, so Avan, it's a simple point that most people get misled into thinking that they are smarter than the market. And there is a thin line between an investor and a trader. The investor invests his surplus money with a long-term view. The trader trades the price and he is leveraged. So when you take a leverage trade, just for an example, we have a cash equity market which does 10 to 15,000 crore on a single day, whereas the derivative does anything between 2.5 lakh to 3 lakh crore. Almost 20 times the volume is generated in the derivative side, which is a speculative market and which has a price movement daily. Now over there is a leverage trade, and generally when you are trading when you take a position on a trade, rather than being long or short, you tend to trade the price, and that is where the folly lies. So the trader never becomes the investor and the investor never becomes the trader. In simply put, it means that if you bought Infosys at the example I was giving for 10,000 rupees, and you tried to trade it for 100 rupees, you lost out on the greatest wealth creator of all time. And if you bought an RCOM at 750 or 800 when it was at its peak, and you held on to it on a trading position, you lost 90% of your capital. So the trader and the investor is a very, very thin line. The investor never becomes the trader and the trader never becomes the investor. That is where you tend to lose confidence, money, and you blame the market.
That's some interesting advice, and Ashu, I want you to elaborate a little bit more on that, because perhaps the young minds today are a little apprehensive. I read an interesting quote that said that the worst enemy of a person investing in the stock market isn't the stock market, but it's your emotions. So one needs to be very guarded as well. What advice or pearls of wisdom do you have for our young minds?
Yeah, I think it's been long discussed over and over again that investing does not involve only fundamentals or only the knowledge about the market. It has a lot to do with the psychology. And that psychology is the result of all these, trading which is happening. Like Sanjeev mentioned, 90% of the volume in today on the exchanges, trading volume. So even if you don't want, you will enter as an investor, even if you don't want. I think me, everyone sitting in this room, all these media, news channel and lot of information, global connect, will force you to become a trader. I think that is the discipline which you have to adopt. It's easier said than done. It's certainly easier said than done, but it doesn't happen. You can't close your eyes and, for example, the example Sanjeev gave, RCOM, somebody's trading position, I would flip that. RCOM also would have been an investor's position. Still it lost 90%. So you cannot remain in the current market, you cannot remain docile with your portfolio forever and wait for 20 years to multiply. RCOM is not one example, right from the real estate stocks to telecom stocks to many other infrastructure stocks which were hitting peak in 2008 and everybody was going gaga. Probably, the world they will achieve the world with those stocks. Today they are at almost 10% of the value. So I think everyone has gone wrong. In those days, you can't say that, so it is very difficult. The psychology is a greater part which overrules this market. That's where, as I said, as an amateur, you still have a fair chance that simply invest in the market, don't get too much into the complexity of the market. There's a fair chance you will make money. As a professional, we still every day or every week or every month we identify stock and still lose money. So I think there is no thumb rule. There lot of psychology is there.
Yeah, of course, making mistakes is part of the game. So let's connect with the students and find out what questions they have for our market experts. And our first one from this lovely young lady.
I'm Gauri Mittal from Amity Business School. My question is regarding the interest rates. So as we have seen that economies like China, Japan, Europe and even India are reducing the interest rate, but US is thinking of increasing the interest rate. So don't you think that the end result would be negated, and what do you think would be the overall impact on the Indian stock market?
Yeah, so see, the US has been on an easy money policy from the last 10 years, and that was all to stimulate the economy and also, put a lid to the subprime crisis which rocked the American and European markets in 2008. That meant that bond yields had almost become 0 to 1%, and a lot of money was being chased by the Fed. It was buying back bonds. Now, of course, there has been a change of regime over there, and there has been a change in the GDP growth rates. The US has become one of the largest economies, and is growing at a fast rate, and the Fed has seen that green shoots emerge on all macro levels. So it's in the process of tightening that easy regime. It will still be the Fed funds rate, which is targeted in 2017, is somewhere around 2.5 to 3%, which is still much lower than the global. Now, as a corollary to that, you rightly pointed out that Japan and a large part of Europe and China are still in the easy money policy. That is again to stimulate their own economies and to have a backlash against the wherewithal of the US economy. So it's a complex field on the bond yields, but definitely India stands to benefit because for once all the macros are in our favor, particularly oil, which has been our 65% of our import bill is on that. That is on a lower, it is at the lowest levels in the last 7-8 years. Our economy is tending to do well, consumption is tending to do well, and as a corollary, the RBI has also cut rates. So the repo has now become 6.5, which is the lowest we have seen in the last 4-5 years. So all in all, on a macro front, it looks India is fairly well positioned to be one of the better markets in the ensuing future.
Let me come in on that, and on the back of that point, I would understand that banking would be a proxy to the India growth story. What's the view from, as to how one should really play the banking space?
So, like I suggested, firstly, the Bank Nifty and the Nifty Bs. The Bank Nifty would be a good proxy because it has 6 PSU banks, 6 private sector banks. PSU banks tend to gain because if bond yields tend to fall, they benefit from the treasury yields and mark to market. And corporate lending, if the rate cut is passed on, cost of return on equity improves for the corporates which are under stress. Also, the government objective of getting asset quality review and so on has had a lot of NPS issues being sorted out in the next few quarters. The second would be the cost of funding ease would mean more credit growth for the retail side of the bankers. Banks like IndusInd Bank, HDFC, Kotak, the private, they tend to do well. So all in all, if you are looking for a proxy that GDP would be 7.5% in the next 1 year and you are looking at credit expansion, then banks seem to be the best proxy to play the market.
Okay, that's a view, bank on banks, but let's have...
I'll still add, because banks, the gap between private and PSU banks was ever increasing, and I would say will increase further. I mean, one has to realize, and as an amateur, I mean, I ask you, everyone, I mean, all in you're in your family, you must have opened bank accounts. I don't think so. I've heard in last 10 years anyone has opened an account in Syndicate Bank or Allahabad Bank or Canara Bank or Corporation Bank. I think all of us are opening accounts in HDFC, Axis, I mean private banks of the world, one. So that is the call on the newer businesses which these private banks are attracting. Secondly, because of the pedigree of these, I mean NPAs, these PSU banks, I mean the older the loan is getting, the more the hole is becoming bigger. It is very difficult for them to, I mean, get those NPAs into order. So I think they are into a very catch-22 situation. So irrespective of the economy recovering or things moving into a better direction, I am still wary of investing into PSU banks and would definitely go with private banks. The gaps will ever be increasing. So one has to be really, I mean, I'm very conspicuous of the fact that I would not like to go with PSU banks.
Cautious on the PSU banks. Let's have our next question then from the second.
Hello sir, I'm Ankush Singhal from Amity Business School, Noida, and my question to you, Mr. Ashu Madan sir. Sir, how do we study the trade cycle of the different sectors, as there is a trade cycle of the sectors? So how one can anticipate the which sector will perform and which sector will not perform? So like if we see the IT sector perform very well, FMCG also performing very well, but if we look at metal sector, they are not performing very well, they have worsened. So I would...
Yeah, it's a very good question, because every day we also baffled with this question, because every time, if I'm on a media or addressing the investors, the first question they ask is, even if you feel the market will go up, which sectors will outperform? I think that's a very, very basic question. Anybody asks, but easier said than done. It is actually a very difficult call. My research, how do I do my research is, I see the ground realities. I see the surrounding around me to identify. I read less into the balance sheets and read more into the reality. I'll give you an example. Real estate. I think last 3-4 years, in your family or neighborhood or friends, you would say everybody wanted to be in real estate, and they thought that is the safest haven to be in, that is the best asset class to be in, because it has been ever rising since last 20 years, given phenomenal returns. India is never short of money. People say there's a liquidity crunch, liquidity problem. India has been never short of money. It has always been short of investment ideas. You give the comfort to a housewife that this is the asset class which is safest and give you returns. The money will flow into that. We have seen in 2008, housewives' money was flowing into the equity market. We have seen in 2010-11, housewives' money was flowing into gold and silver. We have seen in last 3-4 years, everyone was investing into real estate. That is the result. I believe in a contrarian investing idea. So when I see everyone investing into a particular theme, that's not a good idea to be in. So you identify, for example,
diversification also.
Yeah, because consumption is a theme which continue. For example, I just mentioned about PSU banks. Even if I think economy is recovering, even if I think I would stay away from PSU banks. What is the research? I took the research from you. Tell me, any one of you have opened an account in PSU bank in last 2 years? The answer would be none. That is my research. If you look at, for example, aviation, world over they say that's a very difficult segment to be in and to make money. But I still feel that India will convert that theory. Will reverse that theory, because you see, if you travel by Indigo, SpiceJet today, you will find that at least 50-100 of people who would be traveling for the first time. Look at the upgrade which is happening from, the class of people from train to. So
I can vouch for that. My flight was packed on the way here.
Obviously, and it is not about being packed. It is about that how many of them are the first time flyers. So I think the upgradation is happening. So I feel aviation. So this is the research. Do you need any knowledge or balance sheet to understand? So there are so many sectors which you will be able to identify, like healthcare. Today, you go to a hospital, you don't get a single room. If somebody
But look at the state of the pharma sector.
Yes, exactly. So this is the basic research for you. I'm saying that you don't need any expert, you don't need any advisor, you don't need. This is just a basic research and identify a sector. That is what I say is amateur investing, and I can bet that you will be successful.
Sanjiv, a quick word. You want to add in on that? 30 seconds.
Yeah. So he alluded to the point of FMCG and say IT. Now that is because they are cash dependent. They are cash rich companies. 70% of the market, which is in infrastructure and other, are mostly dependent on leverage capital. That is the metal story. We know that a lot of the metal players went overboard in that 2007-8 when the cycle was at the top, and they over leveraged their whole balance sheet. Whereas FMCG and pharma, called defensive sectors, which are going to be they are going to be always in a multiple which is higher than the market because of the cash component and the brand image. Consumption is a big space, so that will continue to be the dominant scheme. Plus, IT is a proxy to the rupee weakness. So if 10 years or 15 years you've seen, as the rupee weakens, the IT company, it's not that Infosys or TCS is working 24 hours. It's just that the weakness of the rupee plays out on their margin and it benefits them. Plus, it's a cash churner for them. Metals is a leverage play, which is a global commodity play. And for example, steel prices went through their worst time, because if the cost of steel prices in India was 25,000, China selling at 21, it becomes uncompetitive.
Okay, so that's quite a bit of advice. Do your homework and watch the on-ground situation. Tell you what, we'll take a quick break right here on BNSN on campus right here from Amity, Noida. Be back with lots more. Welcome back. We're helping our students of Amity University, Noida go to the head of the class when it comes to stock markets with our market expert Sanjiv Bhasin as well as Ashu, Madan. Let's get in our next question from a backbencher all the way over there.
Good afternoon, sir. I'm Sania Makhija, student of Amity School of Economics. Sir, I would like to ask you, what do you think are the factors responsible for the high variation in the major stock exchanges of India? Though they are exchanges of one country, but there is a high variation. So what do you think? Are the government policies favoring one of the stock exchanges majorly? What do you think on that?
See, today there's a global connect. I mean, you see one stock exchange. I mean, if you're talking about only National Stock Exchange or Bombay Stock Exchange, basically you are asking that why so much of volatility in our market because of the various other factors surrounding the world. So there's a huge global connect. I mean, everything is connected. That is why market is becoming more and more complex. I mean, just a while back we were talking about the bond. If you academically look at the bond, bond is a instrument. If it is a 9% coupon rate, you get 9% for 5 years, 9% 1 year, second year 9%, third year 9%, 4. There's nothing. But yet it is the most complex instrument in the world. So similarly, I mean, today with kind of global connect we have, every company is dependent on some other country. I mean, if you look at the pharma sector, the major chunk of investing, I mean, their sales is exports, which comes from Europe, which comes from Russia, which comes from various other countries. Anything affecting them, legal, compliance, I mean FDA approvals. Similarly, IT companies, tomorrow, I mean, if God forbids or I mean Trump comes, look at the policies of Trump. What is he saying? That H1B visas. Suddenly there would be a great impact on the IT companies. So there is for that matter, most of these companies, banks are lenders to big corporates in overseas locations also. I mean, something happens to Greece. I mean, Saudi problem. Everything affects the respective sector of the company. That is why. I mean, you say that there's a sneeze in Europe or US markets, it affects India. That is the, I mean, complexity of the market which you have to live with. That is very important, that today you have to be learned about the entire global economics. I mean, geopolitical situation also to trade in the market.
Okay, I'm loving that we're getting most of our questions from the young women over here. So clearly, looks like there's a lot of interest in the stock markets here. But Sanjiv, I wanted to garner some perspective from you as well. We're talking about so much about government policies, etc. Which sectors, you know, most of the sectors like infra, etc., which are contingent on government policy, has enough been done?
Well, it's in the process, and you know, we talk of the negatives. What about the positives? From reforms in coal, in power, and cleaning up of banks' balance sheets, getting recapitalization of PSU banks, and fourthly, you are seeing that that whole mega problem of spectrum auction, the coal auction, all being resolved. For once you have, and plus, you know, the biggest of them all, Uday, where you have translated 75% of the state electricity boards written off by the government of India and 25% being passed on to state. All that has streamlined a lot of the backward integration which was stuck up. Almost 4 lakh crores worth of infrastructure stroke, you know, commodity related plays were stuck up, and that is being released. So in all, that means that it is a very, very bullish sign for the local economy, and globally also your competitiveness starts to pick up as the metals start to play proxy to that. So we think the government initiatives has been very, very proactive, and going ahead also, you know, markets are all about greed and fear. When fear comes, you don't know, and they become very opportune times to participate. When fear is high, you should be greedy. That was the lesson we got again when the Nifty went below 7,000, even though momentarily. If you had bought there, you had the best rally of the month in last 8 years, because you were greedy when others were fearful. Similarly, you were fearful when others were greedy at 9,000. So a lot was promised when the Nifty was at 9,000, how the Modi government will play. That all took a time lag effect. Now it is truly coming on the face, and that's why the market have rewarded greed. So we also think that going forward in the next 1.5 years, key reforms, implementation of government policy on a large part of the infrastructure would be key in taking the indices forward.
I like that line, good to be greedy when others are fearful. But let's get in the next question.
I am Srishti Chauhan from Amity International Business School, and my question is, how should one make an investment decision between a company which is already well established, whereas the other side we have rapidly growing companies like we have HUL and Patanjali. So what all factors should be considered while making an investment decision?
Especially in light of all the new IPOs as well. So any advice there?
Yeah, so simple. There is 2 ways of investing. It's called growth and value. value is always going to be expensive, and HUL is always available at 35 to 40 times price earning because it's a brand, it's established. And like you rightly pointed out, maybe Patanjali has really dented the oral side. Colgate has come out with weak numbers, and the justification of a high premium becomes undoubted. On the other hand, you have growth companies which are coming out from a hiatus. Their base was low and they are starting to show a lot of traction on the numbers going forward. That means the business visibility is very, very powerful. Just in case, if you could analyze what an Apple could do in 2007, you latched on to the greatest wealth creator. But could you analyze what a MacBook would be? That today it's a status quo. So the Apple stock was $30 in 2007. Today it is close to 770. So growth comes at a cost. Value is always going to be expensive. As Ivan mentioned, that IPOs are the next harbinger that is money being raised from the capital markets. Unfortunately, the spate of IPOs we've had has left a sour taste in the investor's mouth. That's normal proxy because investment bankers and managers generally tend to price it to perfection. They leave little on the table for the end investor. But we think going ahead as the economy gathers traction, there will be good IPOs, and that is a good way of starting off if you do a good comparison of peer group and what the IPO process or the company which is coming with an IPO, what is it promising?
And I think the answer lies in your question also. I mean, as Sanjiv said, that growth and value would be always expensive. But Patanjali can give you a lot of growth. Today, if you see, I mean, you love it or hate it, but you can't avoid Patanjali. Somewhere, you'll gradually realizing that, I mean, you can visit, again, the amateur signal that you can see those products coming to your house and you are tempted to go to Patanjali and probably to explore what is happening. So that is the first signs of investing, that today if somebody takes a risk in investing in Patanjali, it can, I mean, that can be a multi-bagger story tomorrow. After probably 5 years or 3 years, you realize that we were talking sitting in this room about Patanjali and somebody who has invested. That's how you have to, I mean, catch growth, and these are the first signs. Big money is made in these theories only.
Okay, that's a view coming in on some of the IPOs and how one should view that. I'm noticing a lot of questions are coming from the front. What about you guys? Were you backbenchers back then in school and college, or right up front?
Well, I had the height constraint, so I had to sit at the back. But generally, I'd always like opinion to be passed on and then get it,
Smart strategy, good one. But I want to talk, since we're running out of time, in terms of what are your targets or views for the markets? Where are we headed?
Well, in the short run, we think maybe we are closer to the top, that 7,900 is a 200-day moving average, and so on and so forth. And plus, result season is now being played out. And as you know, Avan, results have been a major disappointment in the last 8 quarters. But we are seeing a lot of green shoots on the macros doing well, on the rupee, on the bond yields, and on the FI flows. So we think the second half, particularly after August, September, could be the unleashing of a new bull market. And personally, I think the next 2.5 years, equity as an asset class is going to outperform. So if you ask me on an index, I could stick my neck out and say 8.5 to 9,000 on 31st December of 2016, but 11,000 plus for 31st December 2017. And I think that will set the cat amongst the pigeon when really you see a new high and euphoria, and on the back of earnings actually starting to turn positive. We think double-digit earnings could come closer to the last quarter of 2016.
And that would be a key factor, and good to hear that you're a big bull, Sanjiv. A quick quote, Sanjiv, from one of your favorite market gurus that you'd like to leave our students with.
Yeah, well, John Keynes, the noticed economist, he differentiated for me what was trading and investing. And he said, even though you are convinced you are right, the markets can be irrational longer than you can be solvent. So you need money, and if you think you are a trader on the right side or an investor, you need to go through the cycles. The markets can be very, very unpleasant. They can be more irrational than you can remain solvent. So your liquidity is more key than what the market thinks.
Okay, so jump onto the roller coaster, but be prepared for the bumpy ride. I think that's the key takeaway. Thank you so much, gentlemen, for guiding our students with all those pearls of wisdom. And we wrap it up right here on BNSN on campus. Hope you enjoyed watching.
Find us on Facebook at facebook.com/etnow, and don't forget to click the like button. You can also follow us on Twitter at ET Now Live. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ET Now.